While the equity markets have had a rough ride so far this year, the price of gold has been hitting record levels, trading above $3,000 for the first time. Joining us now with more is Andriy Yastreb, VP for Portfolio Research with TD Asset Management. Andriy, great to have you back on the program.
Thank you for having me.
Interesting times indeed. Lots of volatility that's keeping us busy. Let's talk about the commodity space before we get into gold in particular. What's it been looking like so far?
So far, so good. I think I've been talking to some of my colleagues and I'm saying, I don't know what all this, concerns and volatility all about in commodity space. Yeah. Everything looks okay so far. So I have a chart here to share performance of commodities and equity commodities as well. So if you look at the commodity space, Brent oil is down 5 to 6%. I think it's up a little bit today. If you look at copper and gold, for example, those are up double digits, and we're not even done with first quarter of the year so far. And if you look at commodity complex overall, Bloomberg Commodity Index is up about 7% year to date, which is much better than S&P down 4.5%, and TSX being roughly flat. But what's interesting here on this chart is that if you look at commodity equities, so MSCI Commodity Producers Index, that one is up 9%, outperforming commodities index by over 200 bips year to date. And as you mentioned on gold, even though gold is rallying, if you look at gold equities, they're rallying a lot more, up 32% year to date, double the rate of gold rally.
All right, so some interesting dynamics there. Let's stick with gold, this run that we've seen. What has been driving it? Why are we well above $3,000 now an ounce?
So I think the short answer is that in this cycle, it was all about central bank buying, and more recently, it also about positive ETF flows. So until end of last summer, or until last summer, we haven't seen ETF flows kicking in. They started to kick in more recently. But I think the really big question here is why are the central banks buying, right? And I think the short kind of explanation, which explains some of that, is that since the war started between Russia and Ukraine, when Russian assets abroad in Western central banks and Western financial institutions were frozen, that caused some central banks to start rethinking how where they're holding their reserves, in what currencies, and what securities. So that might have been a part of it, but a lot of gold reserves are also held abroad. So in New York, in London, in Switzerland, there's a lot of gold that is being held for central banks abroad. So I think that argument doesn't explain all of it. I think what is really interesting is that if you think about central banks, what central bank is, among all other things, is dozens or hundreds of PhD economists who run all different kind of analysis and research and models. And the question is, like, what are they seeing, right? Why they're migrating to gold? And from my perspective, that is related to something that we're seeing also with Trump, who's focusing on tariffs and also focusing on cutting government spending in U.S. And I think both of those, there's a lot going on there and a lot of reasons for why that's happening. But both of those initiatives, they lead to the same conclusion, is that we need to cut budget deficit. Because if you look at the U.S. government right now, government debt to GDP is around 100%. Budget deficit somewhere around 6 to 7%. And if nothing changes, if we just stay on this track for longer, that would be the level for next 5-10 years, right? And at some point, it becomes unsustainable, right? And we don't just know where that point would be. And I think a lot of these economists in central banks, they think long term, they model that, and they ask those kind of questions. So if you look at where U.S. government debt and budget deficit metrics are right now, they're not that far off where a lot of European, South European countries were in 2006, 2007, before great financial crisis and before European debt crisis. So if you model 10, 20 years out and you say, okay, what's the probability that we have another recession or we have another sort of crisis that would normally have government spend more and try to boost and stimulate the economy? And what would that do to all these metrics again, right? So I think there is increasing risk in U.S. dollar assets and U.S. treasuries longer term. It's not something to worry about, next month or this year or next year. But if you're a long-term investor and you're thinking 5, 10, 15 years out, you start asking those questions. Like the last 10, 15 years, we've seen U.S. government downgraded a couple of times. If nothing changes, are we going to see U.S. government downgraded again? And probability is pretty high, right, with longer periods of time, and if nothing changes. And then on top of that, then becomes a question is the entire entire financial theory and financial markets as we know them, they're built around the notion of risk-free assets. And if U.S. government were downgraded repeatedly in the future,
no longer a risk-free.
what's risk-free, right? So I think people and like central banks and people, investors who look and think very long-term, they're starting to ask those kind of questions and move into gold. And I think last point on that is, if you look at long periods historically, right, and Ben Gossett comes here and he talks about ratios, one asset versus another. What is gold price? And gold price is a ratio. It's a ratio of value of gold versus value of a fiat currency, whether it's US dollar, euro, Canadian dollar, name it. If you look historically, and any 10, 20-year period historically, gold usually beats fiat currencies.
Okay, so we know some of the big macro themes there. If we look at that first chart we showed again, because we had gold of, what was it, about 14, 15% year to date, and almost 16% year to date, but the gold equity index up 32%. It's all about the leverage play that you get through gold miners versus the actual precious metal?
Yes, exactly. And the last time I was here, end of last year, we were talking about operating leverage. And just to briefly kind of explain what it is, right? Let's say you're a gold miner and your all-in cost to produce an ounce of gold is $1,500, right? If gold price is at $2,000, you make $500 profit, which is still pretty good. If gold increases by 50% and goes from $2,000 to $3,000, as long as your cost didn't move, as long as they're still at that $1,500 cost per ounce, your profit just went from $500 to $1,500. So your profit just increased by 200%. So that's the notion of operating leverage, and that's what we're seeing in the market right now.
All right, so commodities having a good performance, gold obviously having a very good performance year to date. Equity markets have been rocky. Part of that picture obviously is global trade uncertainty, tariffs. What about the tariff impact on mining? What are your thoughts there?
So there's several different parts of it. I think on a high level, the mining industry shouldn't be impacted as much by tariffs as other industries. And the reason for that is as long as you're close to a port and have flexibility in terms of your logistics to put your concentrate or finished metal on a ship, you can sell anywhere, right? So if US puts 25% tariff, you put it on port in Vancouver or in the East Coast, and you ship it to China or you ship it to Europe. So from that perspective, like there's not as much disruption in some other industries. The second degree effect is that the United States doesn't produce as many metals internally. So they need to import, and to do that, they need to incentivize, and prices have to be higher in the US to incentivize that. And that we've seen already in gold and copper prices, where there's a divergence between the gold prices or copper prices in London and in New York. And we've also seen inventories being shipped into US, in some cases flown into US, like for gold and for silver as well, in order to preempt those tariffs, right, and move that beforehand. I think there are two other interesting pieces to that. One is that because there is this premium that is developing in the US, if tariffs stay here for longer, if they become permanent, that means that any producer in the US is advantageous. It has like the cost roughly the same, but price is much higher. At a recent conference, I heard both BHP and Rio talk about Resolution Mine. It's a project that has been on drawing board for years. It's been bogged down with court orders and environmental, local protests. Like there was a lot of issues there that people know that it could be a big mine. It could be the biggest copper mine in the United States. But for years, it looked like it will never be developed. Now both biggest miners in the world are talking about potentially developing that mine because price would be there, but also because the new administration would be more pro-business, more open to domestic supply of critical minerals. And then there's also a flip side to that, which is if you're a miner in Canada or Mexico and you're close to making a final investment decision, so you did all the research, you got all your permits, you're ready to go on a mine, looking at this tariff situation, okay, we need to order Caterpillar trucks or other equipment from the United States. We don't know if there will be tariffs on that. And if it's 25% tariff or more, that's a significant impact on the budget for that mine. So I think there's an air pocket developing here where anybody who was close to making a decision and go and invest and build decision, looking at this situation, say maybe we'll just wait and see where dust settles.